Hey everybody, welcome to the podcast. Thanks for joining me. This is the video version of the podcast. I know you guys like looking at graphs as I do and charts and pictures, a little more exciting than just listening to my voice. So let's get right to it. Well, the Dow Jones finished down 60 points, the S&P down 6, and the Nasdaq down 21. It was the worst of the bunch. So and that was after we opened down. We were pretty lethargic all day, and then the stock market popped. So you can see that happen right around 1 o'clock. It popped up, and then of course we gave it back and ended lower on the day. Now these Fed minutes, I think, reiterate what I've been talking about for the past several weeks, which is if the economy continues to get worse, they're going to have to do some type of further round of stimulus, whether it's QE3 or something that's called something different, because we know QE3 has a negative connotation, but it's going to be something similar to that. Remember, these people are politicians, and there's an election coming up, and with the economy getting worse, the economic data getting worse, the non-farm payrolls only producing 18,000 jobs last week, which really started the sell-off Friday and then continued yesterday and subsequently today. This data is going to continue to get worse, and they're not going to sit by and just not do anything. In fact, we already know the pattern, which is they're going to come in and do something. So that's ultimately going to drive stock prices higher, I think, because look, the stock market right now, the news is so negative. We know it's a leading indicator, the stock market. All the news that you and I know, it's priced in there right now. And the internals of the stock market continue to be pretty good. And again, this is a concoction that I look at of highs and lows, number of stocks going up and down, which stocks went up on the New York Stock Exchange that aren't, things like closed-end funds and things like that, real operating companies. How much demand is there for those stocks versus how much supply? And right now, there is still more demand than supply. So you're getting some gyration. And I really believe that, and I've called this kind of the gap trade, it's the period between June 30th and whenever the next round of stimulus comes in, the market's going to gyrate back and forth, but I don't think it's a time to be overly bearish. I also don't think it's a time to be overly bullish either. I wouldn't go in either direction. I wrote a blog piece the other day called the Goldilocks Investor, talking about not too hot, not too cold. Don't be too bullish, don't be too bearish, and I think that's very important for investors to do. I nibbled on some Qs today, large cap technology stocks. Again, the fact that if you wished you had been a part of that rally last week and you didn't get your chance, you get a sell-off in the last few days, you start nibbling on a few things. This is a market of buying the extremes, and we're not really there yet, but what you want to do is you want to be buying when others are panicking. You want to be selling when others are celebrating, and then we're kind of in a range-bound market, I think, for a while, but I think it's going to resolve itself to the upside. But you certainly got to pop when those minutes came out, because it hinted towards QE3. And again, whether they call it that or not, something will eventually come down the pike that's going to boost the stock market. Will it boost the economy? I don't know. None of this stuff has worked so far, but I think it's going to boost the stock market. Now, in the last few days, we've been looking at the S&P 500, and it's kind of a lot of people are saying, boy, it's been going straight down, it's been going straight up. Depending on who you talk to, they have different versions of what they think is going on. But really, when you take a look at it, it's simply moving sideways. And really, from February until now, this has been a sideways consolidating market. And you can see all of the volume has been coming in. Remember, this is the volume kind of turned on its side. All of the volume has covered these levels on the S&P between 1260 and 1360. And so we've kind of gone down to the bottom, gone to the top, gone back to the bottom, went to the top, and now we're pulling back again. Will we go all the way down to the bottom? I don't think we will. We of course bounced off the 200-day moving average, which is the blue line, but I don't think we're going to go all the way back to the bottom. I think we're going to see some buying come in at some point. It could be earnings that lift the market. And remember, companies right now, dependent on the companies, they're pretty. Their balance sheets look much better than they did a year ago and certainly 2 years ago. But what drives the stock market ultimately is earnings. And if those earnings come in okay, stocks are relatively cheap, and the news flow kind of slows down a little bit, and we get some resolution regarding the debt ceiling, this market I think will take off and actually breach the old highs and make new highs. I changed this picture to the weekly picture, and it's interesting. When you go back to 2007, of course, the stock market was selling off quite a bit. What I have in the blue line is a 20-week moving average, so it just kind of smooths things out. You know, it takes out the distractions, it takes out the weekly gyrations, and what you can see is we turned up, of course, in late 09, continued up, went flat, started to roll over a little bit last summer. That's when the flash crash came, which is right in here. We saw obviously issues with Greece, and not just Greece, Ireland, Portugal, Spain. That sounds very, very familiar, doesn't it? Had a lot of volume during that time, a lot of gyrating back and forth, kind of buying the dips, selling the rips was the key back then. But really, we broke out again to the upside, and the blue line, the moving average, moved back up again. Now we're moving sideways once again. So what we've seen for the last several months, the last 5 months of 2011, is really, I think, consolidation in a bull market. And again, many of you may say, how can you say that? Have you not turned on the television set? There is not a good correlation sometimes between the stock market and the news flow. And really what you're seeing right now is a lot of this negative news that we're seeing. Some of it's similar to last summer. Some of the things are much worse than last summer, and some of the things are better than last summer. It's different. But at the end of the day, the only way we can be successful investors is by monitoring what the investors are doing and how much demand there is for stocks, how much supply there is. And right now what I'm telling you is there is not near the supply of stocks that we saw in 2007 and 8 when I was either doing a podcast or a radio show telling you to be careful out there because of the fact that we were starting to see deterioration in the stock market. Now we're not seeing that deterioration. In fact, just last week did we see, the new highs that were on the stock market expanding, the number of sectors participating expanding. Those are all very healthy things going on. So, and I'm not saying that there's a flashing green light where we should be all in. As I've said before, I'm a big proponent of income investing, and I'm also a proponent of holding some cash right now and just not overdoing it one way or the other. I think it's very easy to get whipsawed right now, and it's very easy to be buying at the top and selling at the bottom, and we certainly don't want to do that. But right now, it certainly appears like we're a little more range-bound than anything, even though the news wants to portray it as things are crashing to a halt and things are going to crash before us and everything's horrible. There are some positives out there too, and we have to remember that. But again, at the end of the day, don't invest based on the news. Don't invest based on one earnings report or one piece of data that comes out. This is about, is it a healthy stock market? What indicators are we seeing? And right now, the stock market is still forging ahead. And so I'd rather it prove itself to us and start to turn the corner before I get more invested. I'd rather miss a few points on the upside. But I can tell you that the stock market is still very healthy right now, believe it or not. Now, remember what started all of this last week on Friday. Remember, the market was already overbought, right? It was already looking for a reason to go down. And it's been no news is good news right now. If there's no news coming out, the market's going up. If there's some bad news, then it may go down. But if there's no news or good news, it tends to want to go up. But what we saw last week was we were already overbought. We'd had a tremendous week in the stock market. The prior week was the best week, I think, since July of 2009. So about a 2-year span, and we've had the best week. But what you saw was the non-farm payrolls came down. Now, I put a picture of this on my blog, but I'm going to explain it. Some of you had a few questions on it. The blue line is the S&P 500. The red line is the non-farm payrolls, which is the government number, and that's why it shows 18,000 right over here is 18,000, which is this line. The green up here showing 157,000 is the ADP. That is the private payroll number that comes out a few days before the government numbers. And what you'll notice is the market got all excited because they showed 157,000 jobs being reported. Then the government number comes out and it's 18,000 and the market sells off. Which one's accurate? Probably neither, right? We know that neither. But what you see is both of these, it's best probably to take an average. The red one, the non-farm payroll, is very, very sporadic, very jumpy. The green one's a little more smooth. In fact, if you look at early 2010, remember in 2010 we had a job number that printed about about 450,000 jobs being produced, and then we saw the next month sharp drop of the 200,000. That really never was really true. In fact, if you look at the green line, it just went straight across. Stock market was bouncy during that time because of all this inconsistent data, but in general, these two lines are correlated with the stock market, and that's very important to remember, because if we can produce some jobs, even at 150,000 clip, then I think the stock market can go a lot higher. If we contract and keep contracting and start losing jobs, yes, we will go down. This will turn back into a bear market. However, there's something in between. If we just simply get 100,000 jobs, that's not enough each month to get the economy going, but it is enough to keep the stock market going, I think. But this is really what set it off last week, was this non-farm payroll. It's coming at 18,000, which was really low. Probably get revised one way or the other next month when the numbers come out, because it always does get revised. All right, guys, thanks for joining me. Appreciate it. Don't forget to follow me throughout the day on Twitter, twitter.com/Carl Eggers, KarlEggers. Also, you can go to carleggers.com for the latest blog posts. There's a free subscription in the top right. And, of course, the money management site is eggerscapital.com. Take care, everybody.
This show is for entertainment only, and information provided by the host, guest, and this station should not be deemed as advice. Your investment decisions should be based on your own specific needs. You should do your own research before you make those decisions. As president and CEO of Eggers Capital Management, Carl Eggers may hold securities mentioned in the show for himself and his clients. Just don't buy or sell anything based on what you get from radio or TV. Use your own judgment, or get yourself a trusted advisor.